Your 20s and 30s are often some of the most exciting and challenging years, filled with new experiences, major life decisions, and, for many, the first time managing money independently. These years are critical because the financial habits you develop can set the stage for the rest of your life. Unfortunately, there are some common money mistakes that people often make in these early years, which can have long-lasting impacts on their financial health. By learning what these mistakes are and how to avoid them, you can make smarter financial decisions that build a secure and prosperous future. One of the most common money mistakes in your 20s and 30s is not having a budget. Budgeting might seem restrictive, but it's actually about giving yourself control over your money and ensuring that it's going towards what matters most to you. When you don't budget, it's easy to overspend, leading to debt and missed savings opportunities. Many people in their 20s or 30s don't track their spending, thinking they'll be fine if they don't go overboard. But even small purchases add up, especially when they become routine. The key is to be aware of where your money is going, allocate amounts for essentials, and set aside some for savings. When you create a budget and stick to it, you gain control over your finances, which is essential for achieving long-term financial security. Another significant mistake is not building an emergency fund. Life is unpredictable, and unexpected expenses, like car repairs or medical bills, can happen to anyone. Without an emergency fund, you might end up borrowing money or relying on credit cards, which can lead to debt. An emergency fund is like a financial safety net, giving you peace of mind and protection against life's uncertainties. Ideally, you should aim to save 3 to 6 months' worth of living expenses. It might seem difficult to save this much, but even putting aside a small amount each month can make a big difference over time. Having an emergency fund means you won't have to dip into your long-term savings or go into debt when unexpected expenses arise. A third common money mistake is accumulating high-interest debt, particularly through credit cards. Credit cards can be useful tools if used responsibly, but they're also one of the easiest ways to get into financial trouble. Many people in their 20s and 30s fall into the trap of spending more than they can afford, resulting in a high balance they can't pay off right away. Credit card debt is particularly dangerous because of the high interest rates, which make it harder to pay off the principal balance. It's essential to use credit cards wisely by only spending what you can afford to pay off in full each month. If you're already carrying a balance, try to pay more than the minimum payment to reduce your debt faster and avoid additional interest charges. The next mistake to avoid is neglecting retirement savings. Retirement might seem a long way off, but the earlier you start saving, the more time your money has to grow. Thanks to the power of compound interest, small contributions made in your 20s and 30s can grow significantly by the time you retire. Many people delay retirement savings, thinking they'll start later when they have more income. However, starting early is key to building a substantial retirement fund. If your employer offers a retirement plan, such as a 401k, try to contribute at least enough to get any company match, which is essentially free money. Even if you don't have access to a 401k, consider opening an individual retirement account, IRA. Contributing consistently, even if it's a small amount, will make a big difference over the long term. Another pitfall is not investing or being overly cautious with investments. While saving money is essential, investing is what allows your money to grow over time. When you avoid investing out of fear of losing money, you miss out on the opportunity to build wealth. Stocks, bonds, mutual funds, and real estate are common investment options, each with its own risk and return profile. It's essential to educate yourself about investment options and start with something that matches your risk tolerance. Many people start by investing in low-cost index funds, which provide diversified exposure to the market. Over time, regular investments, even in small amounts, can grow significantly thanks to compound growth. Remember, the goal of investing is not to make quick money but to grow wealth steadily over time. Failing to set financial goals is another mistake that can lead to poor financial decisions. Financial goals give you direction and motivation, helping you make choices that align with your long-term vision. Without clear goals, it's easy to fall into a pattern of spending without purpose. Start by setting both short-term and long-term goals. Short-term goals might include saving for a vacation or paying off a credit card, while long-term goals could be buying a home or achieving financial independence. Write down your goals and track your progress. Setting financial goals makes it easier to prioritize your spending and focus on what truly matters, ultimately leading to a more secure financial future. Another common mistake is lifestyle inflation. As you start earning more, it can be tempting to upgrade your lifestyle, buying nicer clothes, dining out more frequently, or moving into a more expensive apartment. While it's okay to enjoy the rewards of your hard work, be mindful of how quickly lifestyle inflation can erode your savings. Try to maintain a balance between enjoying your income and saving for the future. One strategy is to increase your savings rate each time you get a raise. For example, if you receive a 5% raise, consider putting an additional 2 to 3% toward savings. This approach allows you to enjoy a portion of your increased income while still building financial security. Failing to insure yourself adequately is another mistake people in their 20s and 30s often make. Insurance might feel like an unnecessary expense, especially if you're young and healthy, but it's a crucial part of financial planning. Health insurance, disability insurance, and renters or homeowners insurance can protect you from substantial financial loss if the unexpected happens. Medical bills, accidents, or natural disasters can result in significant expenses that can drain your savings or push you into debt. It's worth investing in adequate insurance coverage to protect yourself and your finances. The peace of mind that comes with knowing you're covered is well worth the cost of premiums. Impulse spending is another habit that can derail your financial progress. With online shopping and easy access to credit, it's all too easy to buy things on a whim. While occasional treats are fine, frequent impulse purchases can add up quickly and impact your budget. Try to adopt a wait-and-see approach before making non-essential purchases. This means taking a few days to consider if you really need or want the item. More often than not, you'll find that the initial urge to buy fades. Practicing mindful spending allows you to make purchases that truly add value to your life while keeping your financial goals on track. Finally, not learning about personal finance is a mistake that can have lasting consequences. Financial literacy is essential for making informed decisions about your money. Many people avoid learning about finances because they find it overwhelming or assume it's too complicated. However, there are countless resources available, from books and online courses to podcasts and blogs, that can help you improve your financial knowledge. Understanding basic concepts like budgeting, debt management, investing, and tax planning will empower you to make better choices and avoid costly mistakes. Taking the time to educate yourself about personal finance is one of the best investments you can make in your future. Avoiding these common money mistakes in your 20s and 30s requires discipline, awareness, and a commitment to building good financial habits. While it's normal to make some mistakes along the way, being proactive and mindful about your money can help you build a solid financial foundation for the future. Remember that financial freedom doesn't happen overnight, it's a result of consistent, smart decisions over time. By budgeting effectively, saving for emergencies, managing debt, investing wisely, setting clear goals, and avoiding lifestyle inflation, you can set yourself up for a secure and prosperous future. Taking control of your finances now will give you greater freedom, flexibility, and peace of mind as you move forward in life.